Now joined by John Wraith, fixed income strategist at Bank of America, Merrill Lynch. Merrill Lynch, that's a new one for me. Let's get down to business. What does the economy really need to hear from the Chancellor today? Is it more stimulus? Because he ain't got much room to move.
No, I don't think it's more stimulus, and anyone who is expecting that is going to be, I think, disappointed. We know the overall fiscal stance is going to stay very close to what it's been all along since this coalition was formed. The government has pinned its colours to the mast of fiscal austerity, and that's not for budging, not now anyway. But clearly, you know, some of the tax changes and spending cuts within that parameter are going to be very important. You know, we're hopeful, but you know, we doubt it's going to be a sea change.
John, as Linda was alluding to there, we might get a headline figure that there's going to be a big drop in the main measure of the budget deficit, but you are urging a certain amount of caution here. It all depends and revolves around the Royal Mail, its pension, just what is going on, because this is quite complicated.
Well, the government has already said that it wants to take over responsibility for the Royal Mail pension scheme. That's running a big deficit at the moment, and because Royal Mail is due to be privatised, the government realises that with pension scheme attached, it's not going to attract any buyers. So it's going to strip out the pension scheme onto the public sector balance sheet and take responsibility for that in the same way it pays pensions for other public sector workers. But as what is currently a private sector scheme, it has a pool of assets attached to it, which amount in round numbers to something like £25 billion. £25 billion of assets, £35 billion of liabilities or thereabouts. The assets they can crystallise now, because the government doesn't run funded pension schemes, it runs unfunded pension schemes, so it doesn't need the assets. And that can reduce borrowing in the short term, but the liabilities, the 35 billion or so of liabilities, they will have to pay out on an ongoing basis over 20, 30 years to come.
So watch the headline figures is basically what you're saying, because there's probably a lot more if we get a big sort of like, a drop in public sector net borrowing. That's basically what you're saying.
It's a one-off improvement and then a gradual deterioration over years to come, yeah.
Linda also mentioned this 100-year bond. Is this just another distraction? What does it really mean?
It was surprising the way it was sort of trailed by the Chancellor a week or two ago. Clearly, there's a requirement or a desire for the government to lock in these low borrowing costs, as we were hearing. But you have to be very careful at the very long end of the yield curve and potentially beyond about what the real strength of demand is at current levels. Because if you try and sell too much debt, or in this instance, potentially bonds that are too long for any sort of natural demand, the risk is you trigger a meaningful sell-off. So, you know, a consultation is certainly needed before we decide whether we're going to try and do this or not. Our instinct is there isn't going to be a great deal of demand for this sort of product.
I was going to also, on that line, given that the fact that the government is desperately trying to reduce its borrowing, do you think we are going to see a significant drop in gilt issuance?
We think only a modest one, to be honest. The Royal Mail scheme could, in due course, have a meaningful impact on gilt sales, at least for the next year or two. But we think that will only happen when the assets the government is taking over are actually sold. So we don't think that's a story for today. One of the problems, of course, is that even though year-to-year borrowing is slowly coming down, the gilts already in issuance continue to mature, and so and have to be refinanced. So in terms of the overall supply numbers, we think they're going to be broadly similar to the current fiscal year.
We know that the government is resolute, but we have to ask the question whether they are following the right path. Are they so obsessed with austerity that they are strangling any hopes of recovery?
Well, it's an ongoing debate, you know, and it is clearly problematic that growth remains elusive in the UK. It's not all down to the fiscal tightening or the less loose fiscal policy that's being pursued by any means. You know, the Eurozone is clearly a big factor, and the global economy has been a big factor. But we're now on official watch from two ratings agencies for a possible downgrade over the next sort of year to 18 months. And that tells you that fiscal rigour alone is not enough to protect your rating. There are other considerations, and ultimately it's a balance that's very difficult to strike. It may be impossible to strike, but what you need to try and do is moderate your debt or allow it to rise more slowly while stimulating growth. And that's why days like the budget are important to see whether any of the measures will actually promote growth.
What did you make of what the Sainsbury's CFO had to say about the UK economy?
Well, yeah, we'd largely agree with it. You know, as you said, it's going to be tough. That's quite clearly the case, and a lot does rest on the consumer. The Bank of England's forecast, for example, which do foresee a better second half to this year, are largely pinned on a stronger consumer. That in large part is expected to come about through lower inflation, which just eases that squeeze on real incomes. But clearly anything that the Chancellor can do to ease the pressure further is going to be helpful.
Now, what the government has been doing is depending on monetary policy to kind of kickstart the economy as it cuts. Is there anything more that the Bank of England can do? Could it do anything more unconventional, perhaps, like the Fed is doing?
Well, potentially, yes, but the Bank of England all along has been very aggressive and open to QE, to its policy of buying gilts through central bank reserve creation that it's pursued on and off for 3 years now. But it's also been very reticent to go anywhere down the road where it would be taking on corporate private sector debt onto its own balance sheet. It views that as the domain of the government. We're going to hear some news today about credit easing, government guarantees for loans to small businesses.
Yeah.
And that's more, as I say, in the Bank of England's opinion, the government's remit than theirs.
The speech starts at 12:30 London time. That's in about 5 hours. John Wraith, fixed income strategist at Bank of America Merrill Lynch. We shall see exactly what's in that red box
Thanks
a
for
little
your
later.
help
Thank you
today.
very much.